Hi, everybody. This is Steve Gorin. Welcome to my third quarter newsletter webinar. Today, we're going to be talking about defined value clauses, S-Corp distributions of properties, and traps for donating a business to charity. And before we do that, I've got to do some housekeeping here. So this program is CLE certified, and CLE certificates will be sent once we verify attendance. If you are seeking CLE for this webinar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, you should write them down, as you will need to provide them in the verification form included in the login instructions sent to you. All CLE instructions should go to cle-tc@thompsoncoburn.com. An electronic survey form will be sent to you after the webinar. We appreciate you taking the time to fill in the form and return it to us. So welcome, everybody. And on the next slide, again, we're going to be talking about defined value clauses. These are essential tools for transferring a difficult to value asset like a business. We'll talk about S-corporation distribution of property, some traps that are there, and some ways to try to move an S-corporation over toward a partnership model. We'll also talk about traps of donating a business to charity and, of course, some of the benefits, too. So going to the next slide, our first code word is value. And, of course, that's because on the next slide we're going to discuss defined value clauses. So here we're on slide 4. So what is a defined value clause? When do you use it? We'll talk about defining how much gets transferred and to whom, and we'll talk about defining the purchase price. Now, when you're going through these slides, you should have up my newsletter, which is also in your on the web page for this webinar. So you would click on my newsletter in the article on defined value clauses when we do that. So my materials have the clauses from all of the major cases. So you can see what worked and what didn't in specific cases in those specific jurisdictions. So I'm just going to go through and give you some general principle based on the cases that are in my supporting materials. So let's go on to slide 5. What is a defined value clause and when do you use it? So I was just recently presenting at a seminar with Stephanie Loomis-Price, and she told me her example of what she thought. So let's suppose we have a choice, purchase $5 of gas. That's a defined value clause because we're choosing to pay $5, and whatever gas it will purchase is whatever gas we'll get. So it's $5 worth and whatever the price of the gas is. And we set our pump at the station, we tell the attendant $5 worth of gas, and it's going to stop when we get to $5. Another example would be you could buy 5 gallons and pay whatever it's worth. So you pump the 5 gallons of gas, and whatever comes on the pump, that's what you pay. So the idea is that we want to do this with our hard-to-value asset. We don't know what the value of a business really is. That's a matter of appraisal. That's a judgment value. I mean, unless you actually have an actual sale to a buyer who is not a strategic buyer but just a regular buyer, you don't really know what the value really is. And so we're going to get our appraisers out there, and then likewise the IRS will then say, well, maybe it thinks it's a different value. So actually, when I'm getting appraisals, I really talk to the challenger when I talk to the appraisal when I get a draft, and I will challenge the appraiser, and I will ask, should this value be higher? Because the IRS will try to make it higher. So I would rather stress test it to see whether the value is high enough, and try to weed out the potential problems, and then do my gift planning based on that, or my sale planning. And just think about it. If you have a promissory note and the promissory note would be paid off in 7 years according to that value, if it were a higher value, it gets paid off in 8 years, who cares whether it's 7 or 8 years you're paying it off? What the client really cares about is whether there's going to be gift tax imposed on that sale. So challenge the appraiser, ask the appraiser whether there's any room for going up, because we know that's what the IRS is going to try to do, and troubleshoot that up front. So the hard to value asset can be transferred by a gift, or by a bequest, or by a sale, or a disclaimer. And a disclaimer is a tried and true type of thing, because the Internal Revenue Code provides for that. Code Section 2518 talks about the rules for disclaimers, and you can do a formula disclaimer. You can say, I disclaim anything over $100,000, and the IRS will respect that. Similarly, you have marital deduction formulas that people use in their documents, and so a marital deduction clause, that's always been agreed as valid. So these are ideas that are tried and true, and we want to apply them when we have these hard to value assets. Now, you have a choice. If you're doing a transfer that's not intended to be a gift, you have a choice between doing a GRAT or a sale to an irrevocable grantor trust. Now, just to make sure everybody is up to speed on this, a GRAT is a grantor retained annuity trust. So the grantor is transferring assets to the trust, and the trustee is paying an annuity back to the grantor. The regulations under Code Section 2702 tell us that when you define the annuity term, you can define it as a portion of the initial value of the assets. So what you would do is you would go and use your software like Tiger Tables or Number Cruncher or whatever else you might have, and you figure out what percentages, what amounts can come back to you and zero out or almost zero out the GRAT. I'd never do a GRAT where the value of what you transfer is exactly equal to what you get back. I always have at least a small gift. The IRS is very concerned if you zero it out totally, but just think about it. You know, if you have a gift of $100 or $1,000, you'll make the IRS happy, and you're really not going to do any damage to your estate plan. So a GRAT is the ultimate defined value clause because the IRS cannot make your gift any significantly higher. The IRS might be able to say, okay, maybe your $100 gift is $150, but it's not really going to do a whole lot more damage than that. So the GRAT is very safe in terms of not having any gift tax, but the IRS does audit the implementation of the GRAT and looks for mistakes you might have made in implementing it. And if you make a mistake in implementing a GRAT, the IRS might argue that your GRAT was invalid and the gift was the entire amount of what you transferred. So a GRAT can be safe, but there are also some risks involved with it. It can also be challenging to do a GRAT with a hard to value asset, because if you wind up having to pay the annuity amount, what happens if the amount, if the asset that you transfer back is not equal to the value? So let's suppose a payment of $100,000 is due, and all the trust has is stock to pay you with, closely held stock. Then when it pays you back your annuity in closely held stock, then the question is, well, what's the true value of the stock? So then you're taking a valuation risk there. So if I do a GRAT with a hard to value asset, I like to do a graduated GRAT. It has smaller payments up front. You can increase them by 20% a year, so you can have really small payments up front and then higher payments as you go along. And so what I'll do for that is I would like to fund the GRAT with cash or other liquid assets that will get you through the first 3 years of payments of the GRAT. And that way, if the IRS comes in and audits, you can say, well, here's the cash I paid. There's no dispute over that. And then once you get past the 3 years and your gift tax statute of limitations is run, then the IRS can't go back and say it was not a good GRAT because your statute of limitations is run. So a disadvantage of a GRAT is that you can't allocate GST exemption up front. So let's suppose you would like to send the assets to a dynasty trust that's outside the estate tax system forever and ever and ever. Well, the only way it stays outside the estate tax system forever and ever and ever is if you have allocated GST exemption to it. And for a GRAT, because the grantor is retaining an annuity, it's included in the grantor's estate for estate tax purposes. And so being included for estate tax purposes, that's called an estate tax inclusion period, or ETIP. And during the ETIP, any allocation of GST exemption is not going to be setting the inclusion ratio. So you can't, during the initial term of the GRAT, you can't allocate GST exemption and get the dynasty trust outside of the estate tax system. Instead, you wait until the end of the GRAT, and then whatever is passing by the GRAT, you have to allocate it then. Well, by the time the GRAT is over, you might not have enough GST exemption to be able to allocate to the whole thing. So you might not be able to make it totally exempt from the estate tax system. So GRATs have an issue of how you administer them on the back end. So GRATs save you from gift tax on the front end, but they do have additional complexity and they do have additional work done on the back end. Contrast that to a sale to an irrevocable grantor trust. In an irrevocable grantor trust, typically you're going to be funding the trust with some money up front, and then you wait a little while, and then you do your sale. The standard lore is that you fund it with about 10%. So, for example, if you made $1 million gift to the trust, then you might follow that up later with a separate sale of $9 million. So the total involved is a $1 million gift plus a $9 million sale, or $10 million. So that $1 million that you put in was 10% of the total deal. So you could do the sale to irrevocable grantor trust, and you get to allocate your GST exemption up front. So in my example, you could make the $1 million gift, allocate $1 million of GST exemption to it, and poof, you're done. Your dynasty trust is good. If you contrast that to the GRAT, and at the end of the GRAT term, the property is worth $10 million, you'd have to be allocating $10 million of GST exemption at the back end. So the sale to irrevocable grantor trust is a lot more efficient in terms of getting GST exemption allocated and getting your assets outside the estate tax system forever. So the sale to irrevocable grantor trust, I view that as kind of an easier deal than the GRAT in terms of there's less complexity in many cases. Sometimes it's more because you don't have enough estate and gift tax exemption to be able to fund your trust. So if you're having an asset you want to transfer and it's worth less than $100 million, there's a way to fund your trust with the sale to irrevocable grantor trust. If it's more than that, then you need to think about whether you need to do the GRAT. So the sale to irrevocable grantor trust, the problem is that the IRS can come back and say, well, wait a minute, you paid too little. That stock that you sold that you claimed was worth only $9 million, it was really worth $15 million. And so now you have a gift of $6 million. The $15 million true value minus the $9 million note that you paid for that. So taxpayers would really like to have a way that they can say, look, I'm selling whatever it's worth for whatever it's worth. And IRS, it's a hard thing to know what it's worth. And I don't care what it's worth. I want to pay whatever it's worth. So that's the idea behind the defined value clause, is that you don't want to have a gift tax. You're not trying to game the system. You just don't know what it is, and you want to use a formula so that you don't have to pay gift tax. And with the sale to Irrevocable Grantor Trust, I recommend disclosing those on gift tax returns, and then you'll get the 3-year statute of limitations running. The estate tax returns now ask if you've done something like a sale to an Irrevocable Grantor Trust. So you do have to disclose it on the estate tax return. So it's not like you're going to be able to hide the sale from the IRS, because you'll disclose it when the estate tax return comes around. Estate tax returns have a much higher audit rate than gift tax returns. So I would rather disclose the sale on a gift tax return and have a lower chance of auditing than disclose it on an estate tax return down the road. So another thing that you can do is you can have a sale between an irrevocable trust. So you're the back end of your GRAT, and you have a trust that's exempt from generation skipping transfer tax, so a GST exempt trust, a dynasty trust that's outside the estate tax system forever. And you might have another trust that's not protected like that because you don't have enough GST exemption to allocate. So then you might have the trust that's not protected do a sale to the protected trust. And so you might do something like that. That way, it's a lot harder to do gift tax reporting, because then the beneficiaries of the trust would have to be filing gift tax returns, disclosing all of those, and you may have a lot of beneficiaries. So you can do gift tax return disclosure and run the statute of limitations on that, but it's just not nearly as easy. Before I get into more of the meat of the defined value clause, I want to mention a recent tax court case. This is not in my newsletter. This Palmolive Building Investors versus Commissioner. And this case was on a different issue, but what happened in this case is the IRS affirmed that it doesn't like having, the tax court affirmed that it does not like the subsequent adjustment clauses. So if the clause says, I'm doing X, but if the IRS audits me, then I'm doing Y. If you do that, that's a subsequent adjustment clause, and the tax court will not accept that. So we don't want to have a clause that says that, and I'm going to get into those differences in a moment. But I just wanted to let you know that issue, it's a very subtle one, but it's alive and well, and I just wanted to have that citation for you. So let's go on to slide 6. So a defined value clause, there's a couple ways to do them. And the way that has had a lot more cases lately has been defining how much gets transferred to whom. So you might say, I'm transferring all of my stock in ABC Company. The first $9 million is being sold to the Irrevocable Grantor Trust. Any balance above and beyond that is being transferred to charity. Now, I don't know what that balance is because I don't know the value. It's according to the finally determined value for gift tax purposes. So what I'm doing is I'm transferring the whole thing. The first $9 million goes to the trust, and the balance, whatever is finally determined for gift tax purposes, goes to charity. And so there have been cases that have upheld that. It's a pretty safe technique if you want to give to charity. Now, another case, instead of saying the gift tax value, then the second case is the McCord case. And in that case, it was a similar type of thing, but instead of saying it was the gift tax value, what it said is it's the fair market value, and the charity and the trust would negotiate. So in the McCord case, the charity and the trust actually did negotiate, and they came to a settlement. And the key on that is the grantor or seller, the transferor, was not involved in the negotiation. So the grantor says, I'm getting rid of all of this, and I don't care who gets it. It's up to the transferees to negotiate between them who gets it. But I'm either selling it or giving it to charity. And it's up to the transferees to figure out who gets how much. So taking it out of the hands of the donor may remove any kind of elements of abuse from it. That's the idea. And the court accepted that. Another way to do it is a formula disclaimer with an excess to charity. So I'm giving all of my stock to my daughter. And the daughter says, I'm disclaiming, I'm refusing to accept anything that's above my mom's estate tax exemption. So you can do a formula disclaimer, and the code and regulations will accept that. And that's a way to avoid estate tax, because if the IRS says, well, the value is higher, then you can come back and say, well, according to my disclaimer, I didn't accept anything with a higher value. I only accepted the particular dollar amount. The balance went to charity. And that's accepted by the courts. Then the next one is a gift based on a dollar amount. So I'm giving $10,000 worth of stock. And that's what the stock power says. I'm giving $10,000 worth of stock. And the number of shares I'm giving is $10,000 worth of stock as finally determined for gift tax purposes, and we'll file a gift tax return. And that was the Wandry case. Not that specific dollar amount, but that's the general idea. So those are ways that people have done it. So the first three methods involve gifts to charity. So the client needs to be charitably inclined. And the client should also have a charity who's willing to accept this kind of a gift. And the fourth gift, it can get kind of messy, because maybe you think you made a gift of X shares when you actually made a gift of Y shares. And so when you have your gift tax audit, there's some backpedaling to do. You got to go back and figure out, well, any dividends on that stock, any distributions on that stock, who actually was entitled to them, and you have to kind of go back and redo everything. If you have a pass-through entity like an S corporation or partnership, then you have to go back and amend your tax return, income tax returns. So that can be really kind of messy. And the other thing is, well, you thought that when you said $10,000 worth, you thought you were disposing of all of your stock, but oops, I didn't dispose of all of it. I only gave part of it. Well, then, after the IRS audits you, now you're stuck with this asset back in your estate that you need to get rid of. And so there's a lot of back-end adjusting when you do a Wandry clause, this potential. By the way, the IRS did not appeal Wandry. It also filed a non-acquiescence. So non-acquiescence says, the IRS says, I disagree with Wandry. But I kind of view a non-acquiescence as a chicken approach. The IRS is saying, I don't agree with this, I'm going to fight it. But I didn't appeal it, so I guess I'm not brave enough to fight it here. And in that particular case, the Wandry case was appealable to the 10th Circuit, which has some favorable precedent that I'm going to be discussing in a minute. And so that's why that may be why the IRS chickened out. So maybe if you're in the 10th Circuit and you get Wandry again, you can be braver than if you're in another circuit. Okay, so let's go on to slide 7. So the other way is a defined purchase price. And the defined purchase price there's a couple ways you could do it. One of the ways is if you have all the cash that's available to pay for it up front. Now, this is going to be very rare, but this is the simpler way of doing it, so I'm going to do the simple way first. So if you have all the cash up front, you could put that cash into an LLC, have the members be able to withdraw from the LLC at will with cash, so it's not going to be discounted, and you say, I am selling my stock in exchange for an LLC interest with a value equal to the value of my stock. Again, all determined for gift tax purposes. So that's one way to do it. So you know how much stock you're giving, you just don't know how much of the LLC you're getting back. What I do a lot is this next bullet point. I use a note and I define the sale price as the fair market value as finally determined for gift tax purposes. That's my sale price. And that's based on the King case in the 10th Circuit, which again is in my materials. And the King case is, of course, that's what I think got the IRS to chicken out on the laundry. So there is a case in tax court, the True case, that's my last bullet point, and that was also a defined purchase price clause, but they did it a little bit differently according to the write-up I've seen about it. The write-up that I saw about it said that the price is set by the appraiser and would be adjusted on IRS audit. So I'm transferring my stock in exchange for a note equal to the value according to the appraiser. And if the IRS audits it, then I'm going to use the IRS's value instead. Now, to me, that sounds like a clause that's not allowed. That sounds like a subsequent event. And remember on slide 5, I said you can't do a subsequent event adjustment. That was disallowed in the Petter case many years ago, and the tax court has reaffirmed that. So I'm not really thinking the taxpayer in this case will be successful because it looks to me a lot like, I'm sorry, not Petter, Proctor, the Proctor case. It looks a lot like the Proctor case. So let's go to slide 8, and here's how I do it. Is I do a defined purchase price using a note, and if you look in my materials, I have actual language for you that I put into my agreements. So it's about 3 pages down in there. In the sale agreement, the clause says, in consideration of a sum equal to the fair market value, that the seller is transferring the property. And the fair market value is finally determined for federal gift tax purposes on the transfer value on the date of the sale according to the valuation principles under the gift tax regulations. Seller agrees to file a gift tax return reporting this transaction so as to cause the gift tax statute of limitations to run. So we know that there's going to be a gift tax return filed. We know the statute of limitations is going to run. And so you say the value is the value, whatever that is. The promissory note actually says the principal on the promissory note is the value as defined in the sale agreement. And so we're doing it according to a formula. The formula is whatever the gift tax value is. We're not doing any adjustments now after the fact. We're just saying whatever the gift tax value is. Now, you got to go with something between the date of sale and the time the gift tax statute of limitations expires. So I have a clause in the promissory note that says promptly after the initial determination of the sale price, and then you're going to attach what's called an allonge. And the allonge says, basically, I've gotten an appraisal, and I'm estimating that the amount of the promissory note is $9 million or whatever the appraiser says. This is my estimate for the purchase price. I'm not setting the price at $9 million because my purchase price is whatever the gift tax value is. Instead, I'm setting it at the fair market value. The $9 million that the appraiser determined was merely an estimate of what the value is. And we're going to use that estimate until we know for sure what it is. And, of course, we don't know for sure what it is until the gift tax statute of limitations expires. So we do the allonge, and then we go with that. And then you see toward the end of my little article here, the allonge basically says, effective as of the date of the promissory note, the initial principal amount of the promissory note is estimated to be X dollars. I don't say it is X dollars, I say it's estimated to be, because what it really is the gift tax value, and we don't know what that is. So that's the way that I tend to do my defined value clauses, and the reason I like that is if the IRS comes and audits, then we might need to extend the note by a year or two, but we don't have to take back any of the stock. And so because we don't have to take back any of the stock, we don't have to do more estate planning after that. We're just getting a higher purchase price, so the notice is going to last longer. So a big deal. You have a sale to an irrevocable grantor trust. All the note payments are using to pay income tax anyway, so it's all going to disappear. Now I'm going to move on, and the next code word is distribute, because we're going to talk about S corporation distribution of property. So let's go on to slide 9. So if a corporation distributes depreciated assets, the entire gain from the deemed sale may be taxed as ordinary income. So if you have depreciable or amortizable property inside your corporation and you transfer it out of the corporation, that is a deemed sale to the shareholders. Now, if you have a C corporation, there's just one corporate rate. Here's the big problem is if you have an S corporation and you're selling property that in the hands of a related party would be depreciable or amortizable, then the gain on that sale, the whole thing, is ordinary income. So let's suppose that you paid $1 million for the building, and I'm going to ignore whatever you paid for land. You paid $1 million for the building. You've depreciated the building so that there's no basis left. So you have $1 million of accumulated depreciation, and you sell that building for $3 million. Okay. The whole $3 million gain might be ordinary income, not just $1 million appreciation, not just $1 million recaptured appreciation, but the whole $3 million. This is under Code Section 1239, and again, my newsletter has a cross-reference back to Code Section 1239 so you can see all the rules. Why is it the whole $3 million and not just $1 million? The idea is that if you sell to a related party and that related party can take depreciation deductions at ordinary income tax rates, Congress didn't like the idea that you might get a capital gain treatment and your related party buyer will get ordinary income deductions. So Congress said in Code Section 1239 that if you have a controlled corporation and you do the sale, that's going to get ordinary income treatment. So this rule applies if you make a distribution from the S Corp or the C Corp, if you liquidate it, or you convert by unchecking a box. So the unchecking the box says you might have an LLC, it makes an S election, now it's taxed as an S Corp. Then 5 years later, you decide to uncheck the box and make it be taxed as an LLC. That is a deemed distribution of all of the assets. So you don't really want to trigger this ordinary income. But what about if you would like to get all the future growth outside the corporation? So why do you want to do that? Well, if somebody owns dying stock at a corporation, they get a basis step up in the stock, but there's no basis step up in the corporation's assets. What we would like to do is to take the current value and keep that, but get the future value outside a corporate solution. So that way we don't have to pay tax on the current value, but the future increases in value can be inside a partnership, and you can do a 754 election on the partnership and get an inside basis step up at death. So that portion of it will get a basis step up when the owner dies. So slide 10, the corporation forms a new LLC and starts off as the sole member of that LLC. And then ultimately it's going to drop into where the corporation has only a limited interest in that LLC, and other people have the rest of the ownership. So, but before we do that, we got to get the assets into the LLC. So there are two ways of doing it. So on slide 10, the corporation can just transfer all of its business assets into the new LLC and take back 100% membership interest. Slide 11, an advantage of that is you can choose which assets are going to be going into this LLC, and if there's any assets that would generate complications, you can just hold on to them. The new LLC stays as a disregard entity for a while as you transition to a new structure and get everybody used to working in the new structure. Slide 12. So a disadvantage of that is the piecemeal transfer of assets is a pain in the behind. And some assets are not easily transferable. So the first option, it kind of looks like, well, we can transfer all of our assets. We can do it over time. It can be, a transition where you get used to it. And so maybe that's kind of a nice, easy transition to get used to it. But in fact, as a practical matter, a lot of times people, they just like to get everything done in one fell swoop. So on slide 13, there's a two-step approach. And you can see the slide 13, it refers to part 2P3 Romanet 1. And that's a part of in my longer materials. And of course, you can get that through the link in the newsletter. And that tells you how you can get this done on a tax-free basis. This is what's called an F reorganization. It's under Code Section 368A1F. And again, part 2P3 in Romanet 1 discusses that. So what you do is the shareholders form a new corporation and that they own in identical proportions to the old corporation. And then they transfer their stock to the new corporation. So the stock they take their stock in the old corporation and put it all in the new corporation. So as a result, the old corporation becomes a wholly owned subsidiary of the new corporation. So if you have an S corporation, what you do is the new corporation is going to make an S election, and simultaneously it makes an election for the subsidiary to be taxed as a qualified subchapter S subsidiary, which is also called a Q sub. And again, that's in my materials. And that Q sub, even though it's a separate corporation, it's a disregarded entity for income tax purposes. Let's go to slide 14. So on the left-hand side, you see our structure. A, B, and C, who are the original owners, they own the new corporation, and then underneath the new corporation is the old corporation as a Q sub. So again, the old corporation is disregarded for income tax purposes. The old corporation then merges into an LLC. which you can see at the bottom of the slide. So on the right-hand side, what happens is, instead of having the old corporation there, you have an LLC that's a disregarded entity there. Because the old corporation was a Q-sub, it was disregarded for income tax purposes, and so it's going from one disregarded entity to Q-sub into an LLC, which is a disregarded entity. So there's no income tax consequences to that. And so that tends to be the preferred way of doing it, is to do this this drop down in the merger. And at the end of the day, if there's some assets that you wanted to keep at the corporate level, the LLC can always distribute those assets back down to the parent. Okay, slide 15. Advantage of this is it moves all the assets in one fell swoop. Slide 16, the disadvantage is there's no selectivity of the retained assets, but again, you can just have the new LLC distribute those assets back down into the parent, and there's no tax consequences, so that would work very well. So on slide 17, here is the end result of migrating. Actually, there's here's what you're doing. You're migrating this into a limited partnership structure. So the corporation on the left-hand side takes this LLC that it owns, and it contributes that to a limited partnership. In exchange, the corporation gets an interest as a 1% general partner and a capital account with a preferred return. So this is a preferred partnership. So those of you who might not be familiar with preferred partnerships, it's just like having preferred stock. You've seen for many years you have common stock in the stock exchange and preferred stock. Common stock is the value of all the growth. Preferred stock has a fixed value and pays a fixed dividend. And so this is, you get a capital account equal to the value of what you put in, and you get a preferred return back. So that might be, for example, 8%. So if the company was worth $1 million, and you put in this $1 million LLC in the limited partnership, you get a $1 million capital account back. If you have an 8% preferred return, that means that the first $80,000 of profits would be coming out to the corporation. And then after you lop off this first $80,000 of profits, then you have the residue, and 1% of that comes back to the corporation as a general partner. The other 99% of it goes to the individual owners. The individual owners also need to make contributions to the partnership, which might be cash, might be covenant not to compete. But whatever it is, the cash doesn't need to be a whole lot, because the corporation is getting back a capital account equal to the value of what it put in. And so how the 1% and 99% get split up, I mean, you could put in $1,000 and have the individuals put in $990 and have the corporation put in $10. I mean, it's as simple as that. So this is what I believe to be the preferred structure for something like that. And this allows you to keep your current value inside the corporation, have your future value be in a partnership structure. I use a limited partnership where I can, because the 99% limited partners are not subject to self-employment tax on their distributive share of income. So this is a nifty way to be in a partnership situation and avoid self-employment tax. So that's the big reason why people are in S corporations a lot, is to avoid self-employment tax, and this structure allows you to avoid it as well for any of your excess earnings. So I'm going to say the next code word on the next slide, which is charity, because I'm going to go into the charitable part now on slide 18. So contributions to public charities can be a great idea. We know it's good just to benefit charities. Now, if you have an S corporation, then you have some complications when you make a gift to charity. So first of all, if you give some stock in the S corporation to the charity and the charity holds on to the stock, any income that comes from the S corporation is going to be what's called unrelated business tax, is going to be what's called unrelated business income. So what does that mean? If a charity has unrelated business income, it has to pay income tax on that unrelated business income. If the charity is set up as a trust, it would pay tax on the income at individual income tax rates. So if it's taxable interest income, then it would pay it at the highest tax rate, which is 39.6% right now. If it has qualified dividend income, then it would be taxed at capital gain rates, and that would be at 20%. Similarly, if the S corporation sold a capital gain asset and had capital gains tax, and so that capital gain would pass us through to the charity, then that would be taxed as at capital gain rates. Now, the law says that any income that appears on the K-1 from the S corporation is automatically unrelated business income. So we know that charities normally can get interest and dividends, and they don't have to pay tax on the interest and dividends. A public charity that has stocks and bonds does not need to pay tax on those stocks and bonds. Those are not unrelated business income. But if you put those same stocks and bonds inside an S corporation and gave S corporation stock to the charity, it's going to have to pay unrelated business income tax on those stocks and bonds. So an S corporation stock is just kind of, it's a little bit poisonous. So I'd still rather get the income than get nothing at all, but this income is hit with a tax that ordinarily would not have applied. Also, if the charity sells the stock, then any gain on that is going to be subjected to, is going to be called unrelated business income. Normally, if you sell an asset, it's not unrelated business income. There's a specific exception to that. But there's an override that says, but if you sell S corporation stock, it is unrelated business income. So normally, giving S corp stock to a charity is not the most tax efficient thing to do. Now, if you have an S corp and you're interested in getting a charitable donation, consider having the S corporation donate the assets. So the S corporation would donate would make a donation to the charity, and then the S corporation gets a charitable deduction, and then that will flow through on the K-1 to the owner. So if possible, do that instead. Going on to slide 19. If you contribute a closely held business to a private foundation, you can deduct that only to the extent of the contributed property's basis. So what I would rather do, instead of giving it to a private foundation, is I would rather create a donor-advised fund. And lots of financial advisors have access to donor-advised funds. There are a lot of institutions that sponsor donor-advised funds. So any investment advisor you work with, whatever financial institution they work with, there's likely to have a donor-advised fund. The oldest and biggest one that there is right now is Fidelity, and Fidelity has a group that actually inside they will evaluate these gifts, and you don't have to hire an outside lawyer to evaluate it, and it's a very smooth process. But there are other donor-advised funds that also will do very well. So if you make a donation to a donor-advised fund, then you can get the full fair market value deduction instead of just your basis. And then you can make a distribution out to whatever charity you like. one thing to think about when you're doing a donation to a charity is you might give it directly to the charity, or you might give it to a donor advised fund, have the donor advised fund sell it, and then have the donor advised fund give the proceeds to the charity. There's actually can be an income tax benefit to that. So for example, I had a client who wanted to make a donation to his religious institution. And if the religious institution had sold that property, some of that would have been subject to unrelated business income tax. What we did instead is we gave it to a donor advised fund that's set up as a trust. And the donor advised fund is allowed to take a charitable deduction for the distribution that it would make to the religious institution. And you can deduct up to 50% of your unrelated business income. So if you run it through a donor advised fund, then only half of your unrelated business income is subject to tax. Whereas if you gave it directly to the charity that's using it, then all of it is subject to the unrelated business income tax. So I strongly recommend considering, if you make a donation, do it to a donor advised fund. Another thing to consider doing if you have closed sale stock and you want to give it to your private foundation, you could put it in charitable remainder trust. So like you have C Corp stock, you could put a charitable remainder trust, and the donor's retained interest is only you have a 5%. I'm sorry, the charity has, right, that instead of saying donor's retained interest, that should be the charity's interest is 10%. So you have a 5% or more distribution out to the donor. The actuarial value of the charity's interest is 10%. And so you're having a minimal deduction up front, but you're eligible only for a minimal deduction. And then what you do is you then sell the stock, and then sometime later you give away your interest in the charitable remainder trust. And at that time, the charitable remainder trust has cash in it, and so you can get a deduction for the full value of what's inside the charitable remainder trust, to the extent that you had a retained interest. So if you had an interest in 90% of the charitable remainder trust and you gave away your 90% interest, then you get a deduction for 90% of the value of the trust assets. So going on to slide 20. Oh, I have a question up here. What if the charity is a 51% member of an LLC in contrasting to owning S Corp stock? Does this still result in UBTI? So if you give an LLC that is taxable to, that is taxed as a partnership to a charity. So in that case, if the LLC has business income, then that's subject to UBI. That's unrelated business income. If it has debt finance income, that is unrelated business income. But if all the LLC holds is stocks and bonds and there's no debt involved, then there would be no unrelated business income. So hopefully that answers the question. If you want follow-up, then go ahead and type in the chat box some more. Okay, going on to slide 20. If you do a contribution of a business interest, that can cause self-dealing issues. That's more the case with a gift than it is with a bequest. I'm not going to go into the rules of that. In fact, my paper doesn't really go into the rules. It simply relates to the fact that those rules exist. And if you have a contribution to a charity, there's also may be a limited period under which the charity can own a significant part of the closed sale business. So beware, if you're doing a donation of a business interest to a charity, then there's a good chance the charity will need to get rid of that. In fact, if you donate it to a donor advised fund, they're going to want to have a plan for getting rid of it. The donor advised funds typically want you to have a plan for selling the asset within 1 to 2 years. Now, you can't have a legally binding obligation, but you could have an informal plan. So let's go on to slide 21. So suppose you have a partnership interest and the partnership has borrowed money. It has a line of credit for its ongoing operations. So the partnership income tax rules will say that each partner is deemed to be subject to a portion of the liabilities. So just to give a simple example, if you own 10% of your LLC and there's nothing special going on, then you're deemed to have 10% of the liabilities. And if you give away that interest in the LLC, that 10% interest, then what's happened is that you're deemed to have been relieved of those 10% worth of liabilities. Being relieved of liability is the same as receiving cash. So like if you had a mortgage for $1 million and I paid off that mortgage for you, then it's as if I gave you $1 million. So similarly, when you transfer a partnership interest and you're deemed to have been relieved of those liabilities, you're deemed to have received cash. So you're deemed to have done a bargain sale. And so that bargain sale will cause you to incur tax. So if you give up half of your LLC, if you give up half of your LLC interest, then ordinarily you'll be deemed to have sold it for half of the liabilities that were allocated to you and to apply half of your basis against that. And so that's a trap to watch out for. Another issue is that suppose that you have a charitable contribution of an asset, and the asset doesn't have a long-term capital gain. Let's suppose that that you had some inventory, and you gave that inventory to charity. Well, if you bought the inventory for $100,000 and it was worth $120,000 at the time of the gift, your deduction is only going to be the $100,000 that you paid for it. Because if you sold that inventory, you'd have had $20,000 of ordinary income. So the $20,000 increase in value, that would have been ordinary income, not capital gain, so you don't get a deduction for it. So if you sell asset and if you give assets and if you had sold it, it would have been sold for a short-term capital gain or ordinary income, you don't get a deduction for that appreciation. Slide 20. Okay, I have a question. So what happens if you have property that has debt and it's subject to that debt, and then you transfer that your half of your LLC interest, like I gave in my example. But let's suppose that you guaranteed that debt and you assumed that debt, and you said, look, even though I'm only giving away half of my partnership interest, I am keeping the responsibility for all of my debt. In that case, you haven't been relieved of the liability. And in that case, you don't have a bargain sale. So there is a way to try to avoid that liability for that. Okay, going on to slide 22. If a charitable maintenance trust has any unrelated business taxable income, it's going to pay 100% tax on that. So don't give anything that generates unrelated business taxable income to a charitable maintenance trust. That's the goal. If you have a nominal amount, then maybe you can tolerate it, but don't do that. Slide 23, I already explained what unrelated business taxable income is. I just want to also clue in for you that if there's debt at all related to buying this partnership interest, or if there's a line of credit inside of it, the calculation for what becomes unrelated business taxable income on the sale of the partnership interest might surprise you, and my materials go over a controversial IRS ruling. Slide 24, I already mentioned about an S corporation being automatically unrelated business taxable income. Slide 25, I mentioned about the charitable deduction against UBTI. So again, if your charity is a trust, you get a 50% deduction. If your charity is set as a corporation, you get a 10% deduction. And I already mentioned about the donor advice through pass-through. Slide 26, assignment of income. If property is subject to a legally binding obligation to sell before it's donated, the donor is taxed on the sale. You can get around this pretty easily by being very careful with your letter of intent. When you sign a letter of intent, basically, your letter of intent has basically two components to it. One of them is it says, we're going to be negotiating, and here's what we're working toward, but that's non-binding, that part. The other part is, I agree to keep everything confidential, and that part is binding. But the letter of intent is going to say, there's no legally binding obligation to sell, no legal obligation binding to purchase until we actually do the sale. That should be in every letter of intent. So as long as you do that, you could actually give away the property to charity a day before the sale closes and still avoid the assignment of income argument. My materials go through that. There's a court case called Roundhorse where the sale was all but assured of happening. It was a practical certainty, but there was no legally binding intent, and the court held that the donor was not taxed on the income. Slide 27, charitable split interest. My materials talk about it needs to be a completed gift, so you can't hold too many strings over what you sell. There's a charitable partial interest prohibition. You really can't slice and dice. If you have an LLC, for example, you wouldn't, and you might give away, a vertical slice. So I'm giving away to the charity half of all of my interest in the charity. If instead you say, charity gets the first 10%, the first tranche of profits, and I get the balance, or I get the first tranche of profits and the charity gets the balance, if you do that, you may violate the charitable partial interest prohibition. My materials go into that. If you have an LLC interest and you want to sell it, what I recommend doing, or at least considering, is you put the LLC interest into an LLC holding company. You own 51% of the holding company. The charity owns 49%. So as a 51% member, you can vote. You can do the sale of the underlying interest, and then you can and then that way you can control the sale. That does not violate the charitable partial interest prohibition, so you can control the sale, and that way works. It lets you control it without having a prohibited control. So slide 28, I invite everybody to return for my January 30th webinar on my fourth quarter newsletter. If tax reform passes, I intend to hold another webinar. I encourage people to sign up for my Business Succession Solutions blog, and that's also another way of seeing where my next webinars are, and you can also get prior webinars by looking at my blog. Also, Heckerling in January, the biggest estate planning conference in the country. There's a group of professionals who attend Heckerling, and they do write-ups on it, and they're affiliated with the ABA Real Property Trust and Estate Law section, and they forward those publicly, and I take those reports, and then I will comment on the reports, and I will forward them out to people who are interested in that. So I have a separate Heckerling newsletter, and it's about a dozen or so emails that go out at the middle to end of January, and it's kind of just a one-time shot. You get those emails within a period of a week or two, and then that's it for the year. So I encourage you to sign up for that if you're interested in that. So for those of you who I went too fast and you didn't get the code words, they were value and distribute and charity. I hope everybody comes back for my next webinar, and feel free to follow up with me with any questions you may have. Thank you for listening. Please be sure to fill out your evaluation form and follow up on your CLE documentation with us. Thank you very much.